How ETFs work. One investment that holds many others. Imagine buying a single investment that instantly gives you exposure to dozens, or even hundreds, of different companies. No need to pick individual stocks. No need to constantly rebalance. Just one purchase. That is essentially what an ETF does. But behind that simplicity is a structure that keeps prices aligned, tracks markets, and operates throughout the trading day. So today we are going to walk through how ETFs actually work and why they have become so widely used. Chapter 1: What an ETF is. An ETF, or exchange-traded fund, is a type of investment fund that is traded on a stock exchange. It holds a collection of assets such as stocks, bonds, or other securities. When you buy an ETF, you're buying a share of that entire collection. This allows you to gain exposure to multiple assets with a single investment. Chapter 2: How ETFs are traded. Unlike traditional funds, ETFs are traded throughout the day like stocks. You can buy or sell them during market hours at current prices. This means their price can change throughout the day based on supply and demand. This flexibility is one of the key features of ETFs. Chapter 3: Tracking an index. Many ETFs are designed to track a specific index. An index is a group of assets representing a segment of the market. For example, an ETF might track a group of large companies or a specific industry. The goal is to mirror the performance of that index as closely as possible. Chapter 4: Diversification. One of the main benefits of ETFs is diversification. Instead of investing in a single company, you spread your investment across many. This can reduce the impact of any one asset performing poorly. Diversification is often used to manage risk. Chapter 5: Creation and redemption. ETFs have a unique mechanism that helps keep their price aligned with the value of their assets. This involves a process called creation and redemption. Large financial institutions can create new ETF shares or redeem existing ones. They do this by exchanging underlying assets for ETF shares or vice versa. Chapter 6: Keeping prices aligned. The creation and redemption process helps prevent large price differences. If an ETF's price rises above the value of its assets, new shares can be created. If the price falls below, shares can be redeemed. This helps keep the ETF's market price close to its underlying value. Chapter 7: Costs and fees. ETFs typically have lower fees compared to some other investment options. This is because many are passively managed. Instead of actively selecting investments, they track an index. Lower management activity can result in lower costs for investors. Chapter 8: Types of ETFs. There are many different types of ETFs. Some track stock markets. Others track bonds, commodities, or specific sectors. There are even ETFs designed to follow particular strategies. This variety allows investors to choose options that match their goals. Chapter 9: Why investors use ETFs. ETFs are often used for their simplicity and flexibility. They provide diversification, are easy to trade, and can be cost-effective. They can be used for long-term investing or shorter-term strategies. For many investors, they offer a straightforward way to participate in markets. To wrap up, ETFs are investment funds that hold a collection of assets and trade like stocks. They often track an index and provide diversification through a single purchase. The creation and redemption process helps keep their price aligned with underlying assets. Lower fees and flexibility make them a popular choice for many investors. Although simple to use, ETFs rely on a structured system to function efficiently. This has been a mini Leviathan production. If you enjoyed it, check out our other videos. See you in the next one.